Welcome to the Hughes Optioneering Weekly Workshop, where we scientifically engineer trades for greater profit potential. This is the disclaimer slide. You can pause to read it. We're going to move on. Today we're going to look at AppLovin, or AppLovin Corporation. AppLovin provides a technology platform that enables developers to market, monetize, analyze, and publish their apps. Here's the barchart.com technical opinion rating for app. The bar chart rating is an 88% buy, with a strengthening short-term outlook on maintaining the current direction. Long-term indicators fully support a continuation of the trend. According to Prime Trade Select rules, a stock is in a bull trend on a monthly basis if the stock price is above the 10-period or 10-month simple moving average. The monthly chart shows that app is above the moving average line, so the monthly trend in app is up. Now we're going to look at the daily chart. A stock is in a bull trend on a daily basis if the 50-period or 50-day exponential moving average is above the 100-day exponential moving average. The blue line is the 50-day EMA line, and the green line is the 100-day EMA line. The chart shows that the blue line has been above the green line since May, so the daily trend in app is up. Next, we're going to look at a daily chart that displays the Keltner channel. As a rule, we don't want to buy calls if the stock price is above the upper Keltner channel line. Anywhere inside the Keltner channel or even below the Keltner channel is fine. App is just slightly below the upper Keltner channel line, so app is inside the buy zone. Since the trend is up, we want to buy a call. App has 8 option chains to choose from. We're going to use the DECE15 or December 15 option chain. Right now, the December 15 options have 33 days to expiration. Here's the app option chain for December 15. App closed at 43.79 on Friday. That means any calls on the list from 20 to 42.5 are in the money. Let's take a look at the profit potential for purchasing the app December 15 45 strike call, which is the closest strike to the current price of the stock. The bid-ask spread for the 45 call is 195 to 210. We tried to enter at the midpoint, so we'll use 2 even as the buy price. Our call option calculator shows the profit potential for this call based on app price changes at option expiration from flat to a 12.5% increase in price. We can see that if the app stock price is flat at 43.79 at option expiration, the 45 call will lose 100% of its value. Ouch! This is an unacceptable risk. That kind of loss can wipe out our trading account in a hurry. We developed what we call the 1% rule to help us avoid this kind of risk. The 1% rule says to limit the time value portion of the option we buy to 1% of the stock price. That means the stock only has to move up 1% for the call option we purchase to break even and start profiting. Now let's take a look at buying the 40 strike call to see if it qualifies for the 1% rule. Here's the call option calculator picture for the 40 call. According to the 1% rule, we want the call to at least break even if the stock price is up 1%. The calculator picture shows that if the app stock price is up 1%, the 40 call will lose 14.6% of its value. We want that to be break even or better, so the 40 call does not meet our requirements. Let's see if the 35 call will work. The bid-ask spread for the 35 call is 890 to 960. We tried to enter near the midpoint, so we'll use 920 as the buy price. The 35 call works. If the app stock price is up 1%, the 35 call will make a 0.3% or $3 profit. That's better than break even, so the 35 call is the one we'll buy. The call option purchase calculator also shows that if the app stock price increases by 2.5%, the 35 call will make a 7.4% or $68 profit. If the app stock price increases by 5%, the 35 call will make a 19.3% or $178 profit. If the app stock price increases by 7.5%, the 35 call will make a 31.2% or $287 profit. The 10% and 12.5% numbers are also displayed you can see that the profits get better and better. And notice that if the app stock price does not make the expected move up and remains flat at expiration, the 35 call would only lose minus 4.5% or minus $41 compared to the 100% or $200 loss for the 45 strike call that we looked at earlier. Now we want to review a call option debit spread, aka a vertical call spread. For this spread, we want to buy to open the app December 15 expiration 37.5 strike call and sell to open the app Dec 15 42.5 strike call. We're going to base our entry prices on the midpoint between the bid and ask prices. That means we'll buy the 37.5 call for 7 even and sell the 42.5 call for 330. 7 even minus 330 equals 370. So the entry price or debit cost for the spread is $370. Our call option spread analysis calculator picture shows that the spread will make a 35.1% or $130 profit if the app stock price declines by 2.5%, remains flat, or increases in price when the options expire. If app is down 7.5% at expiration, the trade will lose 18.8% or minus $69. Creating the debit spread will allow us to collect a $330 cash credit to our brokerage account for the sale of the 42.5 call. As we said on the previous slide, this reduces the cost of entering the spread to $370. Here's a note regarding earnings reports. The next app earnings report is scheduled for February 7. Let's review the trades one more time. The first trade was a call purchase. It said to buy to open the AppLovin Dec 15 35 strike call for $9.20. We also reviewed the spread. The spread said to buy to open the AppLovin December 15 37.5 strike call and sell to open the December 15 42.5 strike call at a debit of $370. That's it for this week's Optioneering Workshop. Thank you for joining us. We look forward to seeing you again next week.